Mike, how close are you watching over there? What happens election-wise over here?
We're watching very closely. I mean, I think it's absolutely key in several ways. I think that the first thing is that if we get the Republicans maintaining control of the House, then there's obviously the potential for further tax cuts for the middle classes, which would, I think, create an environment where bond yields would go higher in the US and probably globally on the back of that. So I think it's important to watch from a government bond perspective. On the other hand, if you do see that rise in bond yields, it's not quite clear to me that that's good news for equity markets. We've seen equities struggling to digest higher moves for bond yields. If, on the other hand, you see Democrats take control of the House, then I think you're stuck with this fiscal fade that's likely to kick in beyond the end of 2019 as we slow into 2020. And I think that poses a potential risk for growth beyond the end of 2019. And so when you add it all up, it creates an environment where I think at this late stage in the economic cycle, no matter what happens with the election outcome, it's going to be important to be adding some resilience into portfolios.
Okay, let's dig into that a little bit more closely here, Mike, because there has been a school of thought that we have heard often on this network in the last couple of days and weeks that if by somehow the GOP keeps the House, that's not expected, but listen, we've seen polls be very wrong before. If the GOP keeps the House and the Senate keeps control, that would be good for equities. Sounds like you're saying maybe the opposite because the credit markets might move in a way that would be negative for stocks.
Yeah, so what I'm just slightly concerned about is that in that environment, were you to see a tax cuts 2.0 come through, and that drive bond yields in the US, government bond yields in particular, higher, as the market has to digest the fact that there'll be further Treasury issuance, the fiscal deficit widening out even more than it's currently expected to do, and the Fed reacting to the stimulus for the economy that could come with that. I think it's not clear to me that that's good news for equities in an environment where you get the Fed, which are already gradually shifting away from accommodative monetary policy towards restrictive territory. If they're forced to get towards that restrictive territory quicker because of tax cuts, it's not as clear-cut to me that that's good news for equities.
Okay, when you say if the Democrats take control of the House, that is what the polls expect again, but we'll see if the polls are right this time. They weren't the last time. You said there's a fade in fiscal stimulus. In plain American, what does that mean?
Yeah, so if you think about growth rates, it's obviously a rate of change. So you've had the big stimulus effect come through this year, which has supported the economy with growth coming in very well from the tax cuts. Now, in the first half of next year, you're going to get some stimulus as well as the child tax credits come through, and that will also support growth in the first half of 2019. But beyond that, you start to see a fade as you're not getting any further fiscal stimulus. And the concern in my mind is that you're seeing a Fed who feel they need to tighten monetary policy because the unemployment rate is at very low levels and you're seeing wage pressures pick up. So the Fed is shifting closer towards restrictive territory. And at the point where they start to get to that restrictive territory, you're going to start to see that fiscal stimulus fade as we look beyond the end of 2019. So I think that's where the risks start to build and why it makes sense at this stage in the cycle just to be adding some resilience into portfolios and becoming a bit more balanced.